And that put downward pressure on prices. That led to liquidations of leveraged speculators and gamblers, led to the crash and the bear market. And I believe that relentless downward movement ended on June 13th. So I had tweeted right before that, right before Father's Day in mid-June, that we were stuck in this descending triangle. We were stuck around 30,000 and we were bouncing, but each bounce was lower. And it's this terrible chart pattern called a descending triangle. Well, we didn't get all the way to 15. We got to 17.5 on that wick down on the 13th. And so I think that was the bottom. I think that was the cathartic bottom. I think we're in crypto spring, and spring doesn't mean straight up, right? That's summertime, parabolic move, more speculators. Spring is kind of yuck, right? It's kind of windy, it's kind of rainy, it's kind of muddy, and we kind of just bounce along and consolidate, classify Bitcoin as a risk asset. It's not. It can have periods of time where it functions similar, or I shouldn't say functions, where it acts similar to a risk asset because of the types of market participants that are participating in the market. When you have a very illiquid market like that, it is prone to booms and busts driven by market activity. People say, "Oh, well, it didn't act as a store of value." Well, no, it actually did. So the Fed from 2020 to 2021 printed half of all the dollars that existed in the history of the Republic. Okay, it's a long time, 246 years. Okay, here's an interesting thing. Bitcoin went from 10,000 to 20,000. Exactly what it should have done. But it went to 70,000. That had nothing to do with Bitcoin. That had to do with speculation and gambling. And so if we look at today, absolutely. And it would have to do with increased adoption, increased usage, more people holding it in wallets, more people utilizing it as not correlated and independent of one another. And people say, "Oh, but Bitcoin and the markets were correlated from November to June." Of course they were. In liquidations, in bear markets, in liquidations, everything's correlated. International stocks, emerging market stocks, US stocks, bonds, everything goes down. Again, because liquidations are different than bear markets. Liquidations are when there's too much leverage in the system and people are forced to sell. And again, they don't get to sell what they want to sell. They sell what they have to sell. And that's usually the most liquid assets. So I do believe that we're going to see investors look to their portfolio and say, higher rates probably means lower growth rates in the future because we got, tighter liquidity conditions, millennial adoption. That digital divide is so acute and so wide. And what people miss, I think, is there's 37 odd trillion dollars with a T, trillion, that's going to go from my generation, the boomers, to your generation, the echo boomers. That's a lot of money. That money's not going to stay at Merrill Lynch and UBS and invest in municipal bonds and IBM. I believe it's going to migrate into the digital asset ecosystem and put, constant rising pressure on prices. And, the next halving occurs, January, February of 2024. And usually the market will anticipate that by about 9 months. So we're talking about, April, May of next year. And then, and remember, it feeds upon itself. So the first investors come in because they look at the value and then they look at the price and say, well, the price is below the fair value. So if the value of the network is around 20,000 and the price is 19,000, I'm going to buy that. Then as the price moves up into the low 20s and the value starts to creep up, now the traders just get involved because they're like, oh, it's moving, it's going up. Well, then what happens is people look at the halving and say, well, if the block rewards get cut in half to 3.25 from 6.25 to 3.125 from 6.25, then the price has got to double-ish in order for the miners. It's 3 to 5 years, and it comes from simple math that if we take gold, the gold value in the world is 10 trillion, but half of that doesn't count, right? It's chalices and jewelry and stuff that you can't really use. The other half is the monetary value, the bricks and bars that sit in people's, accounts and, Fort Knox and, Swiss bank vaults and all that stuff. That's 5 trillion. 5 trillion, okay? If you think about 21 million Bitcoin is probably less than that. You do that math and you get a 250K number.